Picture the doors opening at a massive retail clearance sale. People sprint down the aisles, grabbing items entirely blind. The product itself matters less than the red discount sticker on the box. That tag triggers a frenzy where shoppers buy first and think later. When the stock market crashes, investors follow the same pattern. Rational thinking vanishes as people rush to grab any stock they can find because the price has plummeted. The scale of the current market discount is significant. Right now, up to 1/3 of all listed stocks are down 50% from their absolute peak. It is a market-wide liquidation. However, buying a stock solely because its price dropped in half is a trap. In a retail store, a 50% discount often signals an item is broken or obsolete. Stocks operate on the same principle. A low price tag is not a guarantee of value. This chart shows the massive market drop in March 2020, followed by a sharp V-shaped recovery. While a panic pulls everything down initially, a specific group of resilient companies eventually recovers to reach new highs. Finding those resilient companies requires ignoring the short-term noise and applying a strict 4-step filtration checklist. Without this filter, buying during a crash is indistinguishable from gambling on clearance stickers. But with it, you can use the panic to acquire premium assets at a fraction of their true value. Step 1 is sector selection. You have to find industries packed with vitamin G, or growth. Specifically, you are looking for sunrise sectors. These are future-oriented businesses developing technologies or services that are small today, but will be unavoidable in 5 to 10 years. To see why this matters, look at the old brick-style flip phone. Once a dominant technology, today it is entirely obsolete. Investing in a dying sector is a mistake, even if you pick that industry's best company. The core rule of vitamin G is that rapid expansion hides many flaws. If an entire sector is growing into the future, even the 10th-ranked company in that space can generate wealth for an investor. Choosing a high-growth sector provides a better foundation for success than picking the top-performing company in a disappearing industry. Step 2 is checking for skin in the game, known professionally as promoter holding. This is the percentage of a company's shares owned by its original founders or controlling owners. This pie chart illustrates the mathematical benchmark for this step. Investors generally look for a majority stake of at least 50% held by the promoters. High ownership creates a specific incentive. If a stock price is slashed in half during a crash, a founder who owns 60% of the company loses millions of their own wealth. That creates massive personal financial pressure. This high promoter holding ensures the founder will work to make the company recover. Their personal financial survival is directly tied to the performance of your investment. Step 3 focuses on a specific balance sheet risk called pledging. In retail terms, imagine a store owner who secretly pawned their own cash register just to pay the monthly rent. In the stock market, pledging occurs when a founder hands their shares over to a bank as collateral for a cash loan. This creates a major risk. If that founder misses a single loan payment, the bank takes ownership of those shares and sells them on the open market. This sudden flood of shares often causes the stock price to collapse. A high ownership percentage is only a strength if those shares are free of debt. Investors should prioritize companies with zero or very low pledging. Step 4 is the taste test. This requires verifying your company's performance by checking their quarterly financial results, the reports showing exactly how much they earned over the last 3 months. A story about future growth carries little weight if the company is not generating real revenue in the present. A committed founder and a great narrative only matter if the underlying business model generates actual profit today. This diagram shows the 4-step filter in action. Hundreds of discounted stocks enter the funnel during a crash, blocked by gates: growth, ownership, no pledges, profit. These rules eliminate 90% of cheap stocks, leaving a handful of premium companies. Many investors lose money because they avoid this filtration work, choosing shortcuts or speculative tips instead of analyzing the business. Market crashes provide a rare window of opportunity for those who can separate a temporary price drop from a permanent business failure. By treating a market panic like a calculated clearance sale, an investor shifts focus from gambling on red stickers to acquiring lasting equity.